Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And on today's episode, well, you are absolutely in for a treat. Gabby and I, we looked at a few questions that people have been asking and sending into us lately. So questions like, should I wait for the market to drop? Should I try and time the bottom? What happens to me if I buy now and the market drops? Or I'm scared to buy a property if rates keep rising. What do I do? So if you've been asking yourself any of these questions, man, you are in for a treat because we ripped that apart. We use facts, data. We use some really powerful insights to actually show you what the facts are around all of this kind of stuff and how you can make better decisions. Now, I personally love this episode, and I know that when I finish recording an episode and I'm just like, man, that was awesome, that usually they're the episodes that other people go, man, that was awesome, right? And so I'm telling you, I've just finished and I'm like, oh, some gold in there. So I can't wait to share this with you. So I'm going to shut up and I'm just going to let's get into it. And I hope you're excited too. And I would love to get your feedback. And if you've got any questions that you want to submit that you would like us to answer on the show, just like this, then you just send them through to til@dashdot.com.au. And of course, if you find this episode valuable, make sure you share it with a friend, family member, or loved one. It's how we help grow the show. It is how we help other people. It's how you can make a difference in the lives of people around you. So get stuck into it, share that around and give it to someone who you care about. But without any further ado, let's get stuck right into it. And I can't wait to see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me today is Gabby, the wonderful, enigmatic Gabby Billing. Gabby, how are you today?
Everyone's favorite guest. Am I a guest? Who knows? We'll make it up.
Yeah, I was trying to go about to combine the words guest and host, and it was going to be ghost. And I was like,
ghost. I'll own it. I can do that.
Oh, you're the ghost.
Gabby the ghost.
You're the
yes.
ghost. Gabby
well, I would argue that I'm everyone's favorite host, right? So we can start that debate.
I mean, look, I'm not going to argue with you. I'm not actually like, if you're looking for an argument, you're not going to get it from me. I know the reason that people come here is because they're looking.
Debate.
Yeah, but I'm not going to argue with that. I know what people really like. People love it when you're on the show. So anyway, what's going on, Gabby? What have you been doing?
What have I been doing? We went coffee hunting this morning. I say hunting like it's a sport.
I'm so happy you brought that up because if you didn't bring it up, I was going to bring it up.
Top of mind, right? Priorities. Sunday is like, set up for the week, get your groceries, whatever. Priority number one is coffee. So we found this new coffee roastery place. Amazing.
Awesome. So good.
Yeah.
Such good coffee. And yeah, I'm really stoked that we've got a good new local roaster so we can get good fresh beans once a week. Loving it.
Yeah.
Super excited.
Yeah.
Yeah. Awesome. Well, I was excited by that too. I thought it was a great start to the day. I'm actually on my third cup of coffee today. I hope no one's judging me. But no,
I've been counting quietly.
You've been counting. You've been counting. Coffee bean counting.
Oh, no.
Anyway, we're not here to talk about as much as people care about our coffee drinking. That's not really what we're here to talk about today because they care about a whole lot of other things too, right? So
apparently, I mean, I don't know what else people are caring about other than coffee.
No, more specifically, our coffee. I don't know what else people are caring about other than our specific.
True. All there is in the world is Goose and Gabi's coffee. Oh, man. Okay. But yes, you're right. We're here to talk about other things.
What are we here to talk about?
Look, there's a lot going on in the world, right? There's a lot happening. There's a lot. I mean, I feel like there's always a bit of fear in what is happening in the world. Like, it's been a pretty wacky couple of years, right?
Aren't you over it? Aren't you just fucking over it? Like
I am, yeah, but you can empathize. I empathize a lot. I empathize too much, as you know. So there's a lot, and it's been a heavy, confusing, stressful, lots of changes, lots of like, what the hell do I do kind of questions just bubbling in the back of people's minds all the time. And so we've actually we want to take this opportunity in this specific podcast to pull apart, what are some core questions that seem to consistently come through from people about current environment, current economy, current property situation. What questions are people asking and how can we serve? yeah, so we've got some questions. We're going to hit them. And you've got quite a bit of prep because you love a good fact.
Well,
You love a good stat.
What I think is important, right? What I think is important, because you're right. The last couple of years, it just feels like it's nonstop. There's always something, whether it be killer COVID, or whether it be monkeypox, or bloody the Chinese debt crisis, or the war in Ukraine. Not trying to downplay the war in Ukraine. It's a terrible situation. Like there's always something. Interest rates are going up. Property market's going to crash. Australia is going to fall into some kind of economic oblivion. There's going to be World War III when China. It's like there's
aliens are coming.
Oh my God! It's just like, yeah, that I wouldn't be surprised. I hope so. It'd be fun actually. Cool.
It's not over that.
It's not over that.
3 coffees and aliens. Let's go.
No, but the thing is, like, there is just like, I think that by and large, a lot of people got doom fatigue. But also, do you know what happens when when I say doom fatigue, I mean this constant barrage of negativity that keeps getting pumped through. People are getting sick of it, I think, to be honest. But here's the rub, right? There's a couple of like unfortunate side effects, right? So constant exposure always leads to some form of contamination. I heard that quote the other day, and it was by a chemist, right? It was a guy being a chemist his whole life, like, nuclear chemistry or whatever. And he said constant exposure always leads to some form of contamination. And that is so true, like of the people that you hang around, right? For example, or the environment that you're in, or any of this kind of stuff, or what you're feeding your mind with. If you get consistently exposed to anything, whether it be uranium or bad news, right, you are going to get some form of contamination. And the problem with this is, even if people are intrinsically kind of going, I'm just over this constant barrage of negativity, and all these like bad headlines and stuff, if that is what you're consistently exposed to, it takes a very strong mind to be able to cut through that noise, right? Obviously, the easiest way to do it is just to turn off the noise, right? That's the easiest way to reduce the exposure and reduce the level of contamination. Pretty simple, right? And but also what happens over time is, when your body and your mind is consistently submitted to negative stimulus, what it actually does is it continuously puts your body into a fight or flight mode, right? And so what it does is it raises your cortisol levels unbeknownst to you. So anxiety levels are probably a little higher, and all of that kind of stuff. These are all like real side effects. Like there's physiological impacts of this constant barrage of negativity that people get. And I actually think that it's becoming a public health issue, right? And because it's also becoming a public wealth issue, because where people are getting put into this state of fight or flight, they're starting to freeze. They're starting to go, geez, I just don't even know anymore. Logically, I'm questioning if this is even true, but man, it's like, and so it puts people into a state of doing nothing. And when they get into a state of doing nothing, they make no choice, which is still a choice. And that choice can actually be worse than making some choice. And so, yes, I put a little bit of prep into getting some stuff ready for this episode, because I think it is damn important for people to be able to make objective decisions. Now, I don't mind what decision people make. I am not here to try and convince everyone that they have to go and buy property, right? What I want people to be able to make educated and informed decisions, right? If that decision is to buy a property, which personally, I think there is a really good argument for that. However, everyone has completely different set of circumstances. So I'm not here trying to spruik like, oh my God, you're an idiot if you don't go and buy a house right now. No, it's cool. I don't understand your situation. That's all good. But what I absolutely am passionate about is making sure that people are making decisions based on fact, not based on fear. And so I'm very excited to answer some of these questions today and about to kind of like bring some perspective to that.
Cool. Let's get into it. So question number 1, should I wait for the market to drop?
That is a great question. And so like the underlying part of that question is, should I try and time the bottom? That's actually kind of the underlying part of that question. It's like, should I wait for the market to drop? Well, like by how much? Like by 1%, by 2%? What they're actually trying to say is I'm going to wait until the market has bottomed, and then I'm going to get into the market after that. Right? And this is pretty much what they're saying, right? Now, there's a few things I want to like tear apart in this question, which is such a good one, because so many people are thinking that way, because the media keeps telling us that the property market is crashing, right? The property market is going down, right? So there's this great quote that is, I can't remember the framing of it exactly. I'm going to butcher it a little bit, but the only thing that the only thing about economists that is true is, or whatever, it's lies, and more statistics, right? And so basically, depending on how you look at the data, you can have a narrative which actually does factually point to the Australian property market declining, right? But here is why that is complete nonsense, right? So number one, there is no Australian property market. There's 15,264 suburbs in Australia. Now, I want to be super clear on this, right? Only about 5,000 of those suburbs are statistically significant, okay? So there's 15,264 towns and suburbs in Australia, but only about 5,000 of them are statistically significant. So what do I mean by statistically significant? So that means that they've got high enough sales volumes and stuff that you can truly reference the data without there being massive holes in it. They've got high enough property values that they don't just become an anomaly when one property gets sold and all of it. So you've actually got to kind of like shave out some of the noise in order to be able to get statistically viable sample size and results, right, when you're actually looking at the property market. But it sure as hell ain't the five major capital cities, right? That is not the property market. But here's where the data gets a little bit skewed depending on whose narrative it is, right? And I've got to say the media typically has a very Sydney-centric narrative, and then they roll in some of the other capital cities when it makes sense to support the narrative. So the problem with the way the current conversation is it frames the property market. Oh, sorry, let me walk back. We've kind of so the problem is Sydney as a market, right? The total market cap or the total value of all of the real estate assets in Sydney is so big that if there is a decline, particularly in the higher end of the market where the values are more asymmetrically larger, then it can pull down the overall aggregate value of many of the other parts of the country. So a simple way to explain this concept in a way that people might understand a little bit better. So BHP, right? BHP is the largest company on the ASX, right? By a pretty long way, right? It's the number one in the ASX 200. If BHP went down in value by 20%, what do we think would happen even if all of the other companies in the ASX 200 stayed exactly the same, didn't grow, didn't decline, what do we think would happen to the ASX 200 index, right? I'll tell you, it would go down, right? And so then you could argue that the ASX 200 is crashing when in fact one company in the ASX 200 is potentially crashing, but not all of the other companies in the ASX 200, right? And so this is effectively what is going on right now. So I want to kind of just keep pulling on this thread. And Gabby, if you want to get in there, just let me know, because I'm 3 cups of coffee deep and we're starting to talk stats, right?
You're right. Numbers,
right? So we actually did a study internally here. I said to our data science team, I said, hey, can we actually have a look at how many suburbs are actually growing in value right now? And we looked at it on a 1 month, 3 month, and 6 month historical basis. So we said, okay, how many suburbs in the last 1 month have gone up in value? How many suburbs in the last 3 months have gone up in value? How many suburbs in the last 6 months have gone up in value, right? Because I wanted to kind of get these numbers. You know what look, and all of those numbers are great, right? But I'm not going to get as bogged down in too many. I'm going to pull out the one fact that I think is the most interesting, right? That across all of those time periods, so for the last 6 months, 53.16% of statistically significant suburbs have gone up in value consecutively every month over those 6 months, right? So what that tells us is that over the last 6 months, over half of the suburbs in Australia are growing, right? But the media is telling us that the property market is crashing, right? So, and this is where the nonsense comes into it, because there is so much variability. Property markets are a local affair. So in order to understand what's happening in the property market, you actually need to look at what's happening in that specific area. So 53% of suburbs, as at today, have been growing consecutively every month for the last 6 months. But if we look at the total number of suburbs that have grown over the last 6 months, it is 88.86%, right? So, but that means the reason that number is so much higher, right, is because they may have gone up for 2 months and down for 1 month and then up for whatever. Get the point, right? So they may not have done it consecutively every month for 6 months, right? But that is pretty bloody interesting in and of itself. That 88.86% of suburbs in Australia still on aggregate have grown in value over the last 6 months, which is completely opposite.
Yeah,
of
people
what
don't realize that. Yeah,
totally, it's mad, right? So right, and the lowest figure is looking at like how many of them consecutively grew over the last 6 months, and that is 53.16%. All of the other numbers based on a per month or like on a 1 month, 3 month, 6 month basis are significantly higher. So I find that to be the most interesting one because it's the most conservative and also the most consistent. Now, the other thing to consider with all of this is why might, because the media keeps telling us that the property market is going down because of interest rates. So there might be some people thinking, okay, well, if interest rates are still going up, then the property market is still going to go down. So we've already proven that is not the case. Over 50% of the suburbs in Australia are still growing, which is crazy, right? Which is crazy. But we also did another study, which is awesome. I said to the data science team that we've got here again, I said, hey, can we actually measure the correlation coefficient between median sales price growth and interest rates? Now, I'm going to break down what that means in simple layman's terms, right? The correlation coefficient is literally what is like, how correlated are the two things, right? Interest rates and median sales price growth, right? So basically, if interest rates go up, do property prices go down? Do they go up? Or like how actually measurably, what is the relationship between those two things? Because if we listen to the media, they tell us it's basically 100%, right? Right? Interest rates go up, prices go down. Interest rates go down, prices go up. That's simple, right? And so what they're trying to tell us is that there's an absolute correlation, probably something in the 90th percentile to the 100th percentile, right? Which is that it is dictated, like the markets are dictated by interest rates. What is so fascinating, right, is that we found results that were absolutely the antithesis of that statement. So we looked at the property market and interest rates from January 2000, and we looked at the correlation coefficient between all different markets. So all of the capital city markets and all of the regional markets in aggregate. So you're sort of like Greater Sydney, rest of New South Wales, Greater Perth, rest of WA. You break them into these the different kind of like categories of zonings of regions, right? So we broke up the country into all of those different regions, and we looked at it on an immediate basis. I've got to remember off the top of my head, but it was basically like a 3 months, 6, 12, 18, 24 months. We looked at it on all these different time series to go, okay, if interest rates go up, does it affect all areas? Does it affect no areas with nationally, all of this kind of stuff? And we looked at that across all of the different areas. And what we found is that there is actually a correlation between those two things, but it is so weak. It is so weak that it is basically negligible. I would argue that it is not. It is almost insignificant, right? And so to give you some context around that, at no point was the correlation between interest rates and median sales price growth greater than 30%, right? And in those cases, the specific example of when it hit 30% was in Sydney and Canberra at the 18-month lag period. So if interest rates went up, property prices might go down. There's a 30% chance that prices might go down in Sydney and Canberra, for example, 18 months after interest rates go up. That was the strongest correlation. That was the most likely relationship, right? And that studied all markets in Australia since 2000, along with interest rates, right? So this is a pretty good study. Only a 30% chance that they might go down in a couple of places. But most of the time, the correlation coefficient was like less than 10%, which means that there's less than a 10% chance that interest rates are going to have any impact on property prices in most parts of the country over any time series, whether it be 1, 3, 6, 12, or 18 or 24 months, right? So that is a fact-based approach to actually trying to work out what actually is happening here, right? And so the point of that is that the drivers of property markets are not interest rates, right? So going back to the question, people are like, should I wait for the market to drop? So firstly, they're perceiving that the market is A, going to drop, or B, is dropping, and C, that they can actually find the bottom of the market. Okay, so if we have proven that the market is not dropping, in fact, statistically speaking, or scientifically speaking, more than 50% of the suburbs are actually growing, right? Okay, so the market isn't crashing. Okay, and scientifically speaking, there is a negligible correlation. So when I say negligible, less than 30%, and in many cases less than 10% correlation between interest rates and median sales price growth, which like basically nothing. I mean, I'm not going to gamble on a 10 to 30%. Would you? Like those odds are dumb. Like those odds are really dumb. If you had a 30% chance of winning, a game of blackjack, would you play it? No, you wouldn't, right? Like, huh? No, that being said, I don't know what the odds are in blackjack, so maybe, yeah. but
maybe.
Right? But so it's predicated on those two things, right? And so if you can kind of deconstruct that, it's like, well, number one, is it even going down? And number two, what would be causing it to go down? There's loads of other factors that cause property markets to move, right? And it ain't interest rates. Let me just put it that way. Put it really, really simple. Now, the kind of second part of that, time in the bottom, is how would you know? Like, how would you know?
Yeah.
Is the bottom of the market today? Are we there? Is it going to go up tomorrow? How would you possibly know? Right? There's 24 million odd people in Australia or thereabouts. How would any of them know? How would you actually get to that decision? Now, transparently, we actually have the tools, not to be able to do that perfectly, but to be able to do it pretty bloody good, right? So we can actually see, is the market going to go down or is it going to go up? Could we time it to the day? No, absolutely not. We can't do that, right? But we can get pretty good. Like we can get pretty close and have a really good idea of, is it going to go up or is it going to go down, to the point that we can actually start to make educated assessments on when people should exit suburbs, when people should enter suburbs, and all of that kind of stuff to be able to maximize their opportunity in those locations. The average punter doesn't have that. We've spent like $3 million now developing this system, something along those lines. Like most people just don't have that capability. So how would you even do that? If you believe that was something that you could do, tell me how you're going to do it, right? And so this thought about should I wait for the market to drop, I think it is a net result of the fear that people are being fed, or the narrative that people are being fed, that is factually incorrect, right? It's just factually incorrect. Because in a lot of places, like the markets aren't just growing a little bit, they're actually still growing a lot. Gabby, do you think I've answered the question, or do you think I need to explore any of that in a little bit further?
The only thing that I'm thinking is actually like, okay, so you've pointed out how historically, the last 1, 3, 6 months, there's been consistent growth in over half the suburbs.
Mm-hmm.
When the media narrative is so strong that, not to drop the R word, but a recession of some sort is looming, I'm sure people are still thinking like, yeah, but, a recession's coming, so shouldn't I wait for that to happen, So we're proven like historically it's been consistently growing despite the doom kind of conversation.
Yep.
But how do we know that that's not around, and doesn't it make sense to wait until that happens to try and, collect all of these cheaper assets if that's what my strategy is?
It's a good question. So a couple of things on that. Number one, if you actually go and have a look at, now, I always say don't listen to the media, and economists don't know what they're doing, right? But nonetheless, you should always fill your mind with inputs, right? You should always still put the inputs in. You need to do multiple things. You need to take all of the information, then go find alternative information and find conflicting information and form a worldview that is uniquely yours, right? And so what is interesting right now is that the jury is totally out on whether or not we're going to go into a recession. Like even the media narrative is starting to change around that, which is pretty interesting, right? Roughly 50% of economists around Australia, there was a big survey recently, roughly 50% of economists said we're not going to go into a recession, and roughly 50% of economists said we are going to go into a recession. And then when you broke that down a little bit further, most of them were putting odds, whatever side of the fence they were on, they were like 60-40, 50-50, like they were like right around on the fence. Even the ones who were like, we are, might only be 60-40 that we are. You know what I mean? And so that's barring obviously any kind of global, kind of like existential threat or some other kind of factor. Then you've actually got to look at like the underlying facts. At the moment, we've got a record low unemployment rate of 3.4%. We've got record business and personal savings, around about 400 billion is still in cash savings that people aren't deploying into the economy yet. We've got the lowest business insolvency rate in 35 years. Recently that was the fact. It's gone up marginally, but that fluctuates as well. international migration starting to pour in. There is so much opportunity happening in the economy right now that I think that people need to probably reconsider that position. The other part of that is like, why would there be an influx of properties onto the market selling cheap? Like this is a belief that people have, right? This is a belief that people have. Oh, there's going to be a lot of cheap properties coming onto the market soon.
Yep.
Why? What? Straight up, why? Because I, for one, cannot see how that reality is going to come to pass. And the reason I can't see that reality coming to pass is because we've got record household savings, we've got record low unemployment, right? When banks lend to individuals, they lend based, they put a risk buffer on top of the mortgage, on top of the assessment rate to make sure they can pay if rates do go up. So that's already been done. Most people care too much about status to be the one person in their family or the one person on their street who gets kicked out of their home because they can't afford the mortgage. So what will they do? What would they do? They would bloody,
just about anything.
They'd do just about anything. They'd eat beans on toast. Now, I'm not suggesting that's going to get to that point, right? But people care too much to be kicked out of their home. It's their home, right? So people will fight tooth and nail for that to not even become a reality for them. Now, the only time it would become a reality is if people can't afford to keep paying the mortgage. So banks only foreclose on properties when the mortgages aren't getting paid. So as long as people can pay the mortgage, as long as someone can pay the mortgage, then there's no reason for the bank to call in the loan. Why would they want to? They're making money, right? And so if people can kind of understand that and then go, okay, well, what would the situation be that would lead to that outcome, or how could we, what I just cannot understand it. Does that mean that no properties will come onto the market in a situation where someone is distressed? No. But that happens all the time anyway. And is it going to be some kind of like a tsunami event that is going to, on aggregate, change the course of the property market in Australia? I just don't think so. Like you got to remember, there's 600,000 odd properties get bought and sold every year, right? And so that's a pretty big pool. That's a pretty big number. And so I personally I would just question where people are drawing that assumption from or gaining that belief from.
Yeah, and I think from that, like the fire sale analogy, it's like, I think in a lot of these situations, when people actually do end up selling, it is more of that fear-based rather than like, because you're right, with the home, people will do pretty much anything to try and hold on to their home, like actually having to sell the home that they live in due to the economic environment. It takes a lot to get to that point. Like you get resourceful, you find alternative solutions to get through that time. And it passes, right? Everyone knows that these situations pass. So it's like you do what you can to weather the storm at the time. But I was just thinking, like, I think with the fire sale, it becomes about like people freak out, like, is this not the bottom? Like, I need to sell now. I think it's more relevant, particularly for like property investors. They're like, the market is now going down. And you're like, I better sell now before it gets any worse. And you see this with shares all the time. When shares start to like turn back and you go, shit, better sell, get out. But then everyone thinks like that. And then that's what pushes the price down even faster and there's more velocity. So I think that would come into play there with like, again, trying to like have awareness about this mindset, that this mindset and all of these things in individuals played out across millions of individuals. Like this is what causes all of these changes. Yeah. So I think that helps. I think it helps. And again, I think it's like playing for the long term, like if you buy a property today, property's not a short-term gain. Like you buy a property because you want to hold that asset. Ideally, like the fundamental strategy, it should be invest in an asset that you're going to hold forever, right? That's the ideal philosophy. You're buying the right property, the right place, the right time. So as long as you can hold it throughout, because you're going to have fluctuations in the period of time that you own it. If you hold the asset for 30 plus years, there's going to be economic situations that change. There's going to be like downturns, there's going to be upturns, there's going to be all of these different things. And if you can just get yourself in a position where you can hold it, sure, that turn might happen quicker after you've purchased it, but it's still, you should be expecting that at some point anyway. So I think it's just, again, maintaining that like long-term perspective is going to help as well.
Yeah, what people don't realize about real estate is the prices go up, the values and the prices go up and down every day. They go up and down every day. The thing is, when people own shares, part of the reason shares are like harrowing is because you can see what the price of those shares are at any given point in time. You're like, they're up, they're down, they're up, they're down. Should I buy it? Should I sell it? Should I buy it? And it gets like, it's pretty anxiety inducing, right? The thing is, is the same thing happens in the property market. Like if you overlay, two graphs, one of like daily property values and one of like daily share values, you're probably going to find they're going to look similar. They're not going to follow the same patterns, right? But they're going to look similar. The thing is that most people just don't have a measurement tool to be able to visually represent what that looks like for their individual asset at any given point in time, right? So they assume, right, because they'll usually get an assessment point or a reference point on the value at two very disparate points, right, apart. Could be 1 month, 3 months, 6 months, 12 months, and that usually happens when you're like, hey, I wonder what the value of my house is today, and I'll go speak to a real estate agent, which kind of can work, or you'll go get speak to your mortgage broker and they'll order a bank val or something like that. But the thing is, the time separation between the moment that you bought it or the last time that you checked, and that point could be months, right? If you only check your shares every 6 months, what do you think the likelihood is that the value would be higher than your last time you checked it? Generally, pretty good. Shares are more volatile, not an exact comparison, etc. But you get the point, right? Mm-hmm. If you could track the value of your asset as dictated by the emotion in the market on a per minute or a per hour or a per day basis, you'd probably nearly have a heart attack because you'd see the graph be all over the place like an ECG, right? And that's just how all markets work, right? That is just a fact. And the thing is, that's because value and price are two different things, right? So price is dictated by emotion, right? And you see this all the time. It's dictated by consumer sentiment. How much will people pay? They'll pay however much they think is a good thing at the time based on how they feel, right? Right? And that is selling price works the same as buying price. And people think that you can't buy properties that are under market value. Well, it's like, well, you can. You just need to have someone whose perspective on what the price is different to the perspective of your perspective on what the value is, and also like what an ostensibly a third-party perspective on that value would be, like a bank, right? And that's usually based on their emotion or their perspective at the time, right? So the issue that we face right now, in a general sense, in Australia, is a consumer sentiment problem, right? And so like linking into that is really, really interesting, right? Because as at the time of recording, consumer sentiment is broadly speaking about the same level as it was during the GFC, right? And it's starting to get pretty close to what it was in April 2020, right? Right after COVID hit, we thought the world was going to end. Anyone who was alive and kicking and doing stuff and paying attention to the world, what was going on in the GFC, right? That was like, holy smokes, the entire, monetary and financial system as we know it, the whole basis of capitalism is about to implode. We're going to be entering into a new world order. People are thinking we're going to move to an agrarian utopia, and it's all going to, like, we literally didn't know what the future looked like, right? That was the state of mind, psychology, consumer sentiment back in the GFC, right? And it's almost the same level of confusion, doubt, and uncertainty as it is today. But the facts don't support it. At least during the GFC, there was like some like legitimate stuff going on, right? There's some legitimate actual problems. Those problems don't exist in the current market that there is today. Like, look at unemployment, look at the amount of savings and the investment and all of this kind of stuff that we've talked about already. And so there's an interesting piece right there, right? Because if you could go back to April 2020, or if you could go back to whatever, like mid GFC, when everyone else was freaking out, and you could go and buy property then, how many properties would you buy? You'd probably buy a ton of them, right? And part of the reason for that is because you would be going against the consensus thinking, because you would be able to see the opportunity that other people can't see, right? And so what I want to do, what I'm trying to do is I'm trying to like peel back the curtain, give people a torch and go, hey guys, take a look, because it isn't what you think it is, right? Right now is not what you think it is. And if you are able to think against the consensus thinking, you are going to be able to radically advance, asymmetrically advance when other people are contracting, right? So in times of certainty, in times of uncertainty, there's only really two plays that you can make. There's conserve, contract, which is basically like cut all costs, save all your money, do it. We don't know what's going to happen. do like the chipmunk, getting ready for winter and whatever, and hoard all the nuts. Quick, everyone get inside. We don't know what's going to happen. Don't know when the sun's coming out again. Right? Or you can expand, right? You can gain more ground. You can lean in. You can use the situation to your advantage. There are always going to be challenges, right? No matter where you're at in your property portfolio, no matter where you're at in your wealth journey, no matter what day of the week it is, no matter what year of the decade it is, it doesn't matter whether you're 20, 30, 40, 50, it literally doesn't matter. We face challenges every single day, and there's always going to be someone telling us there's an obstacle, right? But what actually differentiates the people who are successful from the people who aren't successful is independent thought, the ability to overcome those obstacles, right? And the ability to be adaptable, right? Because people think that Charles Darwin said, survival of the fittest. That's actually not true. It's basically, don't have the quote to hand exactly, right? But it's like, it is not the strongest or the most intelligent or whatever, or the fastest that survive. It is those that are the most adaptable. So basically the most adaptable survive, right? Or thrive in this case, because they end up becoming the dominant species. They end up becoming they don't just survive, they become the dominant species, because guess what? Mm-hmm. The other things don't survive, right? And I'm not suggesting that, people are going to fall into some economic oblivion, right? But those people who can adapt more, they create an asymmetrical advantage, right? And so think about it like this, right? If there's a baseline and everyone else around you contracts by 10% and you don't contract at all, what is the asymmetrical difference between you and everyone else when everyone else is contracted by 10%? 10%, right? What if you gain by 10%? Now, you objectively have only gained or expanded or grown, whatever that might mean in the context of that, by 10%. But if everybody else is contracted by 10%, you create an asymmetry of 20%, right? So you're going to be 20% further ahead than everybody else, right? And the only way that you can do that is to look for the asymmetrical advantage. How do I expand when other people are either psychologically, emotionally, economically, or whatever, contracting and pulling back, right? And that's how you can make those kind of gains. And so I've got one more point to make on that. So there was the other thing that kind of really changes the game around who ultimately is more successful is time horizon, right? Is time horizon. Because the most successful people, the billionaires, for example, in the world, they think in decades, not weeks, not months, not even really years, right? They think in decades. And if you want to be a successful property investor, you shouldn't be thinking necessarily like, oh, am I going to look? We help people get really fast gains in property, right? We do that all the time. And there's people that are able to buy 5 properties in a couple of years and, totally crush it. So you can go fast, and you should look for opportunities to be able to move faster, but you shouldn't be making decisions necessarily based on short-term observations, right? And so you shouldn't be thinking, okay, is this property going to make me rich in 1 year? Well, it's like, are you going to hold it for 5? Are you going to hold it for 10? What is your portfolio strategy, right? And so thinking about this in a time consideration, like you expand your macro, which means that you're not going to be overtly concerned by minor deviations in the market, even when they happen when you don't even notice it, right? But even if you do think that is a potential reality, you should be thinking a little differently as well.
Cool. So that was question 1. We've actually kind of I'm just looking at question 2. We've actually kind of wound question 2 into some of those answers already. But question 2 is, what happens to me if I buy now and the market then drops? Okay, we've already kind of pulled apart, but let's answer what we can.
Yeah, so I mean, we have kind of pulled that apart a fair bit in some of the answers already. So firstly, like, does it matter, right? So the question is, does it matter, right? If your price goes, if the value probably goes up and down a little bit on a day-to-day basis, does it matter? No, not really, right? The bank is not going to margin call you effectively unless you stop being able to pay your rent or being able to pay the mortgage. Markets fluctuate all of the time, right? So what happens to you if you buy now and the market drops is ostensibly nothing. You might slow down a little bit, right? But I can tell you that you are more likely to make significant gains by taking action. You are certain to make no gains by doing nothing, right? That is a certainty. Yep. If you do nothing, you have a 0 chance of success.
Yep.
If you do something, what are your odds of success? And I would argue significantly above 50%, right? Because depending on your timescale and your macro, that is going to dictate that outcome. I love, there was a quote that I put together for this from Warren Buffett. Obviously, he's a shares guy, right? And that's cool. But he said, markets don't settle down, they settle up, which is really interesting, right? So by the time the news looks a little bit better, the market has already recovered. And if you miss the recovery, there's a very, very good chance you're going to make it harder to hit your financial goals, which I thought was awesome. Anyone who, markets don't settle down, they settle up. So, all right, let's say you bought a property today and it went down by 5%. What do you think that property is over the next 5 years? Do you think you're still going to be down? Probably not. Probably going to be up a ton, right? And so if you're really thinking about it from that context, the question is like, how much does it actually matter? Like if you look at someone like Warren Buffett, right? Arguably the greatest investor alive, right? I think everyone would probably agree with that. He's a value investor. And as property investors, you should be a value investor too, right? That is like the smartest way to invest. Now, as a value investor, when share markets start to go down, when prices start to go down, what does Warren Buffett do? Buys more. He says, "This is great.
Yeah.
Oh, perfect." When the market is going down, buy. Like even if it keeps going up, just buy. It doesn't really matter because markets settle up. They just keep buying because it's cheaper. They're cheaper now than they were. Now, I'm not suggesting that markets are going to go down and you're going to be able to buy all these cheap properties. I just think that is nonsense. I can tell you for a fact, we're buying. We're buying more properties per month than many real estate agencies sell in a whole year, right? More than some whole towns and stuff sell, move in a whole year. We're buying a lot of properties, right, per month. And I can tell you in absolute terms, right, that it's not like it's a bargain basement bin out there where you're just going to buy all these cheap properties. Or if they are, all right, like maybe question, are you buying in the right place, right?
Value there.
Yeah. Like what's going on there? Because you should be buying it in good markets, not bad markets. But I love this idea that markets settle up, not down. Now, I'm going to go into the third question in a minute if I answer that. So, does that answer this question? What happens if I buy now and the market drops? It's
I was just thinking about
kind of question.
Yeah, with that value investing mindset as well. It's like, again, Warren Buffett is in shares and not property, but the concept of like when something of value is priced cheaper, then buy as many as you can. That works because they have a fundamental belief that it is going to come back up again. If they didn't believe that, they wouldn't buy it. They don't just buy it because it's cheap. They buy it because it is underpriced at that point in time because they know that there are fluctuations. So again, it's like it's thinking that kind of mindset of like there's fluctuations coming. So it's like, sure, things might go down, but they also go back up. And like this asset class that we're talking about here being real estate, like it generally trends upwards over time, right?
Yeah. Price is what you pay. Value is what you get, right?
Yeah.
Just because something is cheap doesn't make it a good deal, right?
Yeah, absolutely.
A cheap pair of shoes in the wrong size is still the
useless.
Wrong size pair. It's useless, right? So just because it's cheap doesn't mean you should buy it, right? It's about really understanding like what are the fundamental drivers and is it a good. Now, just sticking on the Warren Buffett thing there for a little moment, I was actually reading about this. He's taking a huge stake in this oil company called Occidental Petroleum or whatever they're called. Occidental is the name, right? And it's so fascinating because it's a really interesting kind of look at it because this company was worth about $50 billion. And then I think they bought another company or something like that and basically took a bunch of debt appeared on their balance sheet, which effectively took the value down to like, I don't know, I think it was like 4.2 billion, right? From 50 billion, right?
Wow.
But they're a cash generating machine. It's so high margin and so they're already paying back all of the debt off their balance sheet. So Warren Buffett said it was like, it is literally the same business, but it's just trading at like $4 billion versus $50 billion in value. So he's like he's literally buying as many shares as the government will allow him. He's like trying to buy more. And every time he has to go through, because he's just like, what? Hang on, it's worth that. And I can get it for that. And so I just think that it's a really interesting way of looking at it. Now, I will repeat this again because I don't want people to get the wrong idea, right? The property market isn't crashing, right? And it is not the time to go and start scooping up bargain basement prices, right? Can you get good deals in any market? Yes, right? Are property prices going down in some locations? They absolutely, definitely are. That is a fact. In some suburbs, prices are going down. Does that happen literally every single day? And has that happened literally every single day for the last 100 years? Yes, right? There is never a case where all suburbs are going up and all suburbs are going down. It just doesn't exist, right? And so some places are going down in value. Just so like primarily happens to be where there's like lots of journalists living and they're like, oh, wow, everyone loves talking about Sydney and everything like that. But if property prices went down in West Albury, right, would that make headline news? Probably not. If prices go down in Bondi, does that make headline news? Yeah, probably, right? And so really it's a perspective on where you're getting information from and around what. Now, why right now are some places like Sydney and Canberra and Melbourne and to some extent Brisbane now starting to go down in value? Well, again, just tearing that apart a little bit, right? So it's not all of the suburbs in all of those cities, because those cities have all got a lot of suburbs in them. It's not all of those suburbs in all of those cities that are going down. It is some of those suburbs in those cities which are going down. You're probably going to find that some of those suburbs are actually going up in value, right? Because property markets are a local affair, right? Now, back to the interest rate thing though, what is interesting is that ostensibly higher priced markets where people stretch themselves and still use mortgages tend to be more affected generally. And again, the correlation coefficient, which we talked about earlier in the episode, is quite low still. But in a general sense and an anecdotal and an empirical kind of sense, you can understand that in markets where people are stretching themselves, so typically trying to go from middle to upper status, right? They probably still have a mortgage, right? And they're probably leveraged themselves up to try and get a more expensive house and live in a better suburb and all that kind of stuff. Those people are ostensibly more affected, right? And that is because the cost of debt is higher. And specifically, it is much higher relative to the income being generated by the people in that location. It is asymmetrically different, right?
Yeah.
And so like incomes don't really change that much across the country, right? But prices of property really do. And so when you've got really expensive properties and people are really stretching all of their affordability to try and uphold this status, and I'm going to live in, geez, I don't know, Vaucluse or whatever, or Double Bay or something like that, Potts Point or something like that, they might be stretching themselves. Where it actually kind of doesn't matter is like the really wealthy who buy the stupidly expensive houses and pay cash, right?
Cash,
because
yeah.
They're not getting mortgages.
They don't care about interest rates.
Who cares what the interest rate is? Because they're paying cash, right? And so what you might see in the headlines is that trophy homes or whatever are still selling for like 40 million bucks and whatever. It's like, yeah, guess what, guys? They're not getting a bloody mortgage. They're not going down to CPA and going, how can I get a 90% loan on this $40 million house? They're not doing it. They're paying cash, right? But where you see the difference is like in that kind of like 1 million to 10 million kind of range, I would suggest, where people are really stretching themselves, right? And that's where you're going to see much more price sensitivity because of the cost of debt, right? So can situations like this affect some suburbs more than others? Yes. Just in the same way that changes in iron ore prices globally can affect some locations more than others, right? So do you think that if iron ore prices fell by 80%, that some locations would be adversely affected by that? Probably, because, in WA, iron ore is a larger part of the economic makeup of what actually fuels, the government in that. The massive amount of revenue is generated off iron ore, right? Is it more likely to affect Perth than it is likely to affect Sydney? Yeah, because people in Sydney who are in financial services, typically, more generally, right, in a very broad brushstroke way, or more professional services and stuff like that, right, are less affected by the price of iron ore, right? And so what you have is you have all of these different inputs that go into different markets that dictate different things in different ways. The price of beef, right, or trade tariffs on beef might affect some locations but not others, right? And so you have all these kind of like various inputs. It just so happens that right now people are fixating on the performance of less than 50% of the suburbs in Australia and trying to paint a bit of picture. So back to the point, what happens if you buy now and the market drops? I'll go back to it and say pretty much nothing, right? unless you sell the property, you ain't making a loss. Unless you believe that the market is never going to go up again, then it's just, you just need to be patient, right?
Mm-hmm.
Could it slow you down a little bit? Yeah, it could slow you down a little bit. But again, think about the time horizon. Think about what you're trying to achieve. Now, in the analysis that we did around how many suburbs were growing, and remember, just to kind of reiterate and anchor that point back, we did a study on all statistically significant suburbs in Australia, and we found that 53.16% of suburbs have grown consecutively every month for the last 6 months, which is counter to the media narrative, right? If we were to split that out into capital cities and versus regionals, what we would probably find is something like, 80% of regional suburbs are probably growing. And I'm making this up because we haven't done the split, but we may very well do the split pretty soon. But we'd probably find something like 80% of regional suburbs are growing, and maybe only 20% of capital city suburbs are growing, right? Because of this asymmetry between what is happening in different markets in different ways and different reasons. So can you still buy in emerging markets and markets that are yet to become hotspots? You absolutely can. In fact, we're doing it right now, right? So anyway, I'm kind of going a little bit off topic, but does that answer that question, do you think?
Yeah, and I think on the where you started was like if the market, the market, or if your individual property, hits a bit of a dip depending on, which market it is in, which suburb, what kind of environment, what kind of time, banks are unlikely to come in and say, give me your property now. Like that's unlikely to happen. Largely because as long as you can keep making the repayments and keep paying off the mortgage, they don't really care. They're like, as long as you can keep doing that. And in these environments, ostensibly, like as long as your income is the same and you can still afford to pay the income and rents are still the same, neither of those are likely to change, I guess. Like the rents, people still, if you still got tenants in the property, they're still going to be paying rents. It's like the rent doesn't also drop back in those environments. So I think, yeah, just thinking about, again, it's like trying to actually picture what this thing that you're scared of actually looks like for you. Like what am I scared of in this environment? Like I'm scared of this looming drop that everyone says is going to happen. What is actually going to happen in my situation? Like what change is that going to cause for me? And being able to define what that is so you can realize like, okay, actually that's not really likely to affect me, or it will a little bit and it'll affect this aspect, and this is how I can prepare for it. And not just prepare for it, but it's actually realizing that it's not a cause for inaction. Like everyone is kind of seeking these excuses and these reasons to not take action because I think, going back to what you said at the start of the video, like we're all kind of overwhelmed and desensitized to all of the stuff that's happening. So we have this kind of freeze response to the collective like level of trauma that everyone's going through. So we're all kind of just like, I'd rather just do nothing. And so being able to identify like, actually, if I actually just pay a little bit of attention to this and actually just think about this a little bit, what is actually going to come in this, hypothetical doom situation that's about to come, apparently, and defining that so that you can figure out like, this is how I can adapt and prepare. And that's actually just one little piece of my strategy, and it's not going to hold me up moving forward.
Yeah. So you've touched on a really, really good thing there, right? So I'm going to quote you, Gabi, right? I'm going to quote you because you said something really powerful the other day. And you said you should only ever be fearful, or sorry, you're only ever fearful if you don't know what the enemy is. And once you know what the enemy is, you can work out how to fight it. Right. And so in this context, what you're basically saying is like, what actually do you think is going to go wrong? Like, where do you think you're going to be, attacked? Where do you think it is going to, what is the downside risk? And my argument is that ostensibly things are actually significantly better than what we're currently being told. And to borrow from Franklin D. Roosevelt, the only thing to fear is fear itself, right? Because fear puts you into a doom loop. Fear makes you try and find all of the reasons that you should be doing nothing versus objectively looking at the facts and trying to understand what actually is the situation. How can you use it to your advantage? We've got one more question, Gabi.
Yes, let's do it. So question number 3, I'm scared to buy property if rates keep rising. What do I do?
Okay, so there's effectively 2 reasons that people might be scared. Only 2. If interest rates keep rising, prices might fall. or if interest rates keep rising, I might not be able to afford to hold the property. Right?
Mm-hmm.
Pretty simple. Those are really the only two reasons that I think people are really afraid. So, again, going back to the scientific analysis that we did, where we analyzed the correlation between interest rates and median sales price growth across all regions of the country and nationally in aggregate since 2000, so 22-year study that we looked at, 22-year data set, we found that the correlation, whilst there, was very negligible, right? The strongest was 30%, which means there's only a 30% likelihood that it would affect those locations. And that was only in like 2 or 3 locations, or 2 or 3 regions nationwide in one time series, when in actuality, in most parts of the country, across a 1, 3, 5, 1, 3, 6, 12, 18, 24 month periods, there was like less than 20% or less than 10% correlation. So basically less than 10% likelihood that it's going to be impacting those areas, or less than that much of an impact, which is so small. Like, you would not make decisions, but you should not be making decisions based on a 10% potential impact, right? That is just like not a 10%, not a 10% absolute impact. Like, if interest rate rises, it is going to make it go down by 10%. It's like 10% chance that it's even related, that it's even going to do anything, right? Which is really, really interesting, right? So if interest rates keep rising, scientifically, we can show and prove that there is a relationship, but it is very weak and it's pretty negligible. And it's certainly not absolute, and you should be making decisions based on that, right? So let's just park the property prices falling thing, because that's got nothing to do with interest rates, right? Are there reasons that property prices might fall? Yeah. And as we've just discussed, like in some parts of Sydney, probably that is related to the cost of mortgages, right? But it's pretty low correlation, and there's probably other factors too. And even in the case of Sydney, you've still got to remember that macro, the growth is still way above where it was, right? And so people are still making gains. The other part of it is mortgage costs, or the cost of holding those properties. And I think this is a really important one, right? I think this is a really important one, because if you can understand that there's basically no relationship, I don't want to get called out by the data science team, right? A weak relationship.
You can't
right?
say that.
yeah, they're very particular. So a weak relationship between interest rates and median sales price growth. Okay, cool. Right. So let's park that. Then it's like, yeah, I know, but like, dude, I don't want to end up like having to pay heaps and heaps of money. I can't afford it. Right. So the thing to understand there is, and this goes back to the time horizon discussion as well. So I had a look at interest rates over the last like 40 years, and I couldn't, and this is empirical. I was looking at graphs with my eyes and, my fingers and stuff like that, right? So we haven't got the data science team onto it too, but I could not identify, looking at a chart of interest rates over the last 40 years, I could not identify a time where interest rates rose for longer than like 2 years, right? Mm-hmm. That's not to say that it can't happen, but that's just to say historically, it hasn't really happened, right? Not that I could see, right? And again, that was empirically, not quantitatively, right? So it's likely that this is only going to be a temporary situation. And we know that because that is specifically and overtly the point, right? It is not, hey, we're rising interest rates forever because everyone's had cheap money and screw you guys, everyone's going to pay more. It is like the only reason we're rising interest rates, we don't really want to, but we have to because we're going to get inflation under control. As soon as that's under control, yeah, we'll knock them back down again, right? So ostensibly, it should be pretty easy for people to understand that this is likely only going to last for less than 24 months. Okay, so then you got to think macro around, okay, what is my investment strategy and how does this play out? And is this still a good time to invest? And thinking about what the total return is actually more important than thinking about necessarily the cash flow. I'll come back to how to manage that cost in a second, right? Mm-hmm. But macro, if your property goes up by $50,000, but it costs you $2,000 in negative cash flow, you've still made $48,000. Would you choose to make $48,000, or would you choose to make $0 and leave your cash in the bank where it's going to be eaten away by inflation at about 6% or 7% at the moment anyway? So you're going to lose 7% of your cash, or you're going to make $48,000. Which would you choose, right? It should be a pretty simple choice for any sensible investor, right, to still go after getting those good opportunities and taking that on. Now, the other thing is that rents are rising potentially the fastest they've ever risen. Now, I haven't looked fastest they've risen since like 2010, that's for sure. So certainly in the last decade or 15 years, definitely the fastest they've risen, right? In fact, they've risen by, over the last just over 24 months, rents have risen by 33.86%. Rents, that's nationally, right? So that is nationally. So that takes into consideration the areas where rents haven't risen as fast as others. In the locations we've been buying properties in for our clients, rents have been rising by like 20% in a year, right? It's crazy, right? And so even with the rising cost of debt on those assets, that can be offset just by rents going up, right? Because there's all of these factors that are playing into the fact that rents are rising and are going to continue to rise. The vacancy rates are at record lows. People can't build any more houses, or it's very tough to build properties at the moment because of supply chain issues, building company issues, and all of this kind of stuff. Very hard and not very cost effective to be building new properties at the moment, which means less people have got less choices about places to live. We've got immigration coming into the country. You know, they're trying to crank that up to, I think, about 250,000 immigrants a year, which is huge. That's a massive influx, right? And people coming into the country that all need places to live, right? And not only that, we've got it's harder for first-time owners to get into the market, not just because of prices, but also because of debt. It's actually harder to get a loan now because interest rates have gone up. Once you add the buffer rate on top of that, it's harder to get a loan than it was 6, 12, 18, 24 months ago for a first-time owner, which means that there's people who are coming of age and moving out of home who aren't able to buy their own home, or people who are, in their 20s and 30s who still, like, so you're getting more people in that renter pool, right? Because there's less people exiting the renter pool and becoming homeowners, whilst there are still people entering the renter pool. So even without migration, you've still got this expanding pool of people who want rental properties, right? But no more rental properties are being created, okay? And so you've got this situation where there's an increasing demand, but there's no increasing supply. Okay, so not every area is going to be the same, right? Some areas vacancy rates are going up. Why? Because people don't want to rent there. They don't want to live there, right? And this goes back to the point that not all there are, there's multiple markets across the country. Markets are a local affair, right? Not a national affair. And so, but generally speaking, vacancy rates are down, and they continue to go down because there's nowhere for people to rent, and that's pushing rents up. And so the likelihood is that rents are going to continue to rise for the significant future, because there is no policy position to change this state of reality for renters nationwide. In order to fix this problem, it is a gargantuan problem. It is going to be one of the biggest social problems of our lifetimes, that people are going to be stuck and trying to, and even not even being able to find a place to rent. So this actually requires intervention on a government level. This isn't like get more developers to build more houses, right? So there's going to need to be some major kind of shift in order to be able to solve this. And no one is even having that discussion, right? So that it is safe to assume that this trend is going to continue for some time, and that it's going to mean that rents aren't just rising for the next 24 months, they're probably going to continue to rise. And when you buy a property, you lock in the price on day one, right? So, but you don't lock in the rents on day one. You might lock in the rents for 12 months, but then in 12 months they go up again when you do a rental assessment. If people want to renew their lease, etc., you can reset them to market rent, right? And when there is very high demand, you could also be selective about who you get. It's not just like raising the rents and then suddenly ending up with drug addicts and drug dealers renting your property and kicking the walls in, right? Because there are more people trying to rent, and or for all of these factors, you can actually be selective and make sure you're getting good tenants. And so this isn't a situation where you're suddenly going to, so it's actually like the quality of tenant is going up, macro, price of rents is going up, macro. And so you're in this situation where there's a lot of things working for you to be able to make that up. And so we actually just did an episode recently. We're talking about all this kind of stuff a little bit more, but broadly speaking, I don't think people need to be fearful of that, right? And there's loads of other ways that you can offset some of those costs, like putting your savings into your offset accounts and stuff like that to minimize the cost of the debt and all these kind of things. So based on those two fear factors, which is one, the prices are going to fall. Well, that's kind of not true. That's unrelated. And it's going to be unaffordable to hold a property. I just don't see that they are true. They are stories that people are telling themselves. They are not facts that people are paying attention to.
Yeah, and I think you just bringing back a point that you made earlier about when people invest in shares, because you have optics over the daily fluctuations, there's more emotional fluctuations for the investor looking at that portfolio, because they see the up or the down and they go, oh shit, today's a good day, now not a good day. Like, it can change that rapidly. versus if you just looked at it today and then you came back in 12 months, if you bought correctly, it's likely that that value will be higher and you've just removed that kind of emotional response. And I think this kind of comes into play thinking about that. Like the two kind of parts in this are the income from the asset, so being the rent that you're talking about, and the cost of the asset being the interest expense, which is, based on the current interest rate at the time. So I think the thing with the rents is like, because you only have really usually an opportunity to increase that once a year, you give less emotional bandwidth to that situation and give it less weight of the impact versus like interest rates. You hear about it on the news every day at the moment. You're seeing every week, month, whatever, how frequently the prices are changing over time. So I think you're seeing more of the interest rate side and the increase in costs, and then people freak out about that more because they're seeing more, they get more frequent optics. And so the emotion comes into that, and then you get caught in your head of, I don't actually know when that's going to stop. At the moment, it's like this month compared to last month, it's going up. And then that month compared to the month before, it's going up as well. So you're getting that more frequent feedback loop and your emotions are coming into it, comparing it with that other side of the equation, which is the rents, where you only really have the opportunity to increase that once a year. But again, if you're buying correctly, it can relatively neutralize based on the growth of both sides.
Yeah, and again, I think it makes total sense, right? And it's also again macro. Like people need to zoom out, right? People need to absolutely zoom out, because ostensibly, if you buy a property today and it's a 6% gross yielding property, is that good? Yeah. Is there a chance that it might be cash flow negative? Yeah, and there's a chance that it might be cash flow negative. Would it have been cash flow negative 12 months ago? Probably not, based on the cost of debt, right? But could it be cash flow negative today? Probably. I mean, certainly maybe. Depends on a variety of factors, right?
Yep.
Does that mean that is a shit property to buy? Assuming that all of the other factors and stuff, because yield is only one element in making a decision about a property. The point that I'm making, though, is that over macro, like that is going to wash itself out, right? So rents are going to continue to rise over time. You've locked in the price on day one. Mortgage cost of debt is not going to continue to rise. And over a 5, 10, 15, 20-year time horizon, like, are you making a good investment decision? That's the question you've got to ask yourself, right? Not, am I going to be up or down $100? Right? Because you're making hundreds of thousands of dollars of a decision when you're buying a property. And a lot of people are worried about $100 here or a couple $100 there. I am not trying to downplay the impact that $500 a month, for example, could have on a household, right? I am not trying to downplay that. That is real, right? For a lot of people, that would be untenable. But also, when you're investing, you need to be able to think macro, right? Rather than making all of these kind of, emotional decisions based on minor fluctuations, when there's actually a bigger game at play here. And to your point, you go overweight on small details or overweight on external inputs and underweight on strategy and underweight on macro. And that's where I think a lot of people go wrong. Cool. So we were going to do this like Q&A style, but we just went off.
We've got so many more questions as well. So I think we're going to need to circle back on maybe another episode or two, maybe.
Okay. Well, that sounds good. I've enjoyed this. Yeah. I like this format. Guys, if you've enjoyed this too, let us know, and let us know what questions you've got too, because we can answer your questions on the podcast. Send them into til@dashdot.com.au. That's til@dashdot.com.au. Send them in. We'd love to hear what questions you've got about the current state of the market and trying to answer them and help you too. But Gabi, should we leave it there for today's show?
Let's do it. Let's get another coffee, shall we? Coffee number 4. Woo!
It sounds great. Well, I've enjoyed this. Guys, I hope you've enjoyed it too. If you have enjoyed this, do us a favor. Actually, don't do us a favor. Think of someone that you love and do them a favor.
Do yourself a favor.
No. Don't do yourself a favor. Do a favor for someone that you love, right? Because when you're in an environment where there is so much fear and so much misinformation out there, right? It is so hard to get a perspective that allows you to make effective decisions. And that's what I really hope that you get out of this episode. And so if you got that out of this episode, think of somebody else who might be stuck in fear. Think of somebody else who might be making no decision or poor decisions based on these inputs that we've debunked today, and share this episode with them and help them out. Don't do it for us, do it for them. Make sure you share this with a friend, family member, or loved one who needs it. But that's all, folks. We'll see you on the next episode.
See ya.